Greetings and welcome to this video about the Piotroski F-score, a method to highly increase your low price book value portfolio's yield. Such a portfolio, augmented with the F-score, yielded a return over 20% annually over a time frame of 20 years. If you want to know how, hang in and we will try to decipher the magic of the F-score. First, let's talk about where and on which kind of companies you should use the Piotroski F-score. Its primary target is to improve the yield of low price to book portfolios, which have an empirically proven better return over the market of approximately 2%. But one key feature of low PB companies is that they're normally financially distressed. Nothing but around 40% of companies in the last 20% of P2B ratio have a positive market return. This is where Professor Piotroski's research comes into play. He was thinking about a way to shift the return distribution to the right, i.e. he tried to separate the losers from the winners. For this, he tailored a binary score system consisting out of 9 summary performance statistics. Those could get further divided into 3 categories: profitability, leverage and liquidity, and operating efficiency. But before we start with the categories, I want to mention that the score system is binary. This means an indicator can only be good, or 1, or it can be bad, or 0. There are no shades in between those two states. First, let's take a look at profitability. In this category, we have 4 indicators. Those are first, positive net income, second, positive return on assets, third, positive operating cash flow, and fourth, a higher operating cash flow than net income. Those indicators provide an excellent impression of a firm's ability to internally create cash flows from operating activities, and it gives us a rough indicator of the quality of those. Next, we have leverage and liquidity. Those indicators are supposed to identify changes in the capital structures and liquidity. First, we have the ratio of long-term debt. Should this ratio be lower than the previous year, we evaluate with good, or 1. Let's move on. Now we take a look at the current ratio. You can calculate the current ratio by dividing the current assets with current liabilities. This can be taken as a measurement for liquidity. So if the current ratio is higher than last year, we give another 1. The last indicator of leverage liquidity is if the company issued new shares in the last year. This is somewhat the counterpart to the ratio of long-term debt. But on the contrary, does this indicator not measure the change in debt, but in equity? A potentially distressed firm that issues new shares is not a favorable sign. Therefore, only if a company didn't dilute its shares count, we evaluate this indicator with another 1. The last category is operating efficiency. We merely have 2 statistics, the first one being gross margin. Gross margin equals net sales minus cost of goods sold divided by net sales. An increase in gross margin is a solid indicator of decreased costs, the ability to charge steeper prices, or both. Therefore, an increase in comparison to last year can be just as good. Second, we have asset turnover. Asset turnover can be calculated by dividing returns with asset at the beginning of the period plus asset at the end of the period divided by 2. An increase suggests a more efficient allocation of asset and an increase in productivity. Therefore, an increase is again good, or 1. If we now add up the different statistics, we get an F-score in a range from 0 to 9. 0 being the worst possible score and 9 the best. A company with 8 to 9 points can be assessed as a good one, and one with 1 to 0 as a bad one. The annual return of 23% of a low PB ratio, which I mentioned at the beginning of the video, was achieved by going long on quote-unquote good companies and shorting the quote-unquote bad companies. But remember, this combination of statistics is achieved for low PB ratio companies. There might be limited usefulness in applying this to companies that are not in the category. Also, it's noteworthy that the best results appear with small to medium companies that had limited or no analyst coverage. Those companies exist in a not rapid information environment like big companies, where every kind of fundamental information might be correctly priced into the stock price. This lack of coverage gives the opportunity for bigger gaps between the price and value, and therefore higher returns. Lastly, I want to draw a connection to momentum. The F-score might filter out late stage momentum losers, i.e. soon to be early stage momentum winners from early stage momentum losers. This is one more possible explanation for the abnormal return of the strategy over the long term. And that's it. I hope you enjoyed the video. If you did, check out my other videos about value investing and consider subscribing to never miss new videos on Value World. Thanks for listening and have a nice day.